Welcome back to Talk Tickers. This is the place where we strip out all the corporate fluff, we ignore the PR spin, and we get straight to the P&L.
That's right.
Today, we are deep diving into Champion Homes, ticker SKIY. And I have to say, if you were watching the tape on February 4th, you saw something pretty spectacular.
It was hard to miss. I mean, in a market that was pretty choppy, Champion Homes didn't just report earnings, they just took off.
Took off is right.
Yeah.
We are talking about a stock that closed up $8.33. That is a 10.96% rip in one session.
On massive volume, too. What was it? 1.64 million shares.
Yeah, their average is like under a million. So the market went absolutely bananas for this report.
Which is the fascinating part, right? Because if you just glanced at the numbers without any context, just the summary on your terminal, you'd be scratching your head.
Totally.
You've got gross margins compressing, the order backlog is shrinking. I mean, usually that is a recipe for a disaster, a big sell-off.
And yet here we are. That's the mystery we are going to unpack today. Why did the market go crazy for a manufactured housing company with, on the surface, some pretty worrying numbers?
It's a great story. It's about beating with caveats, a massive pile of cash, and a pivot towards the only thing that really matters in housing right now.
Affordability.
Affordability. It's this disconnect between what an algorithm might read in the numbers versus what a human investor sees in the strategy.
Okay, so let's get into it. Let's start with the headline numbers, the beat, because they did beat, and in this market, you have to.
Oh, they smashed it. Adjusted EPS, earnings per share, came in at 96 cents. The street was looking for 84 cents.
Wow, so 12-cent beat? That's not small.
No, in this environment, beating the bottom line by, 14%? That's significant.
And the top line, the revenue, looked good too.
It did, $656.6 million. That beat expectations by almost $10 million, and it was up 1.8% from last year.
Now, I know 1.8% sounds tiny if you're looking at a tech stock, but in housing, with these interest rates, any growth is a win.
Any top-line growth is a huge victory. But,
right.
And there's always a but on earnings, we have to talk about the uh-oh numbers.
Right. Let's not sugarcoat it. The gross margin. Let's talk about that squeeze.
It dropped to 26.2%. That's down 190 basis points from this time last year.
And for anyone listening, 190 basis points is almost 2 full percentage points.
Exactly. And in a business like manufacturing, where you're dealing with lumber, labor, transportation, losing 2% of your profit on every single home you sell is usually a 5-alarm fire.
And it wasn't just margins, right? Adjusted EBITDA was down too.
Down about 10%. And the one that usually really spooks investors, the backlog.
What happened there?
It fell over 15% from the prior quarter, down to $266 million. Your backlog is your future revenue pipeline, right? When a company says our waiting list is shrinking, investors usually run for the hills.
So let's just recap this. Margin down, backlog down, cash profit down, but the stock is up 11%.
It feels like a total contradiction.
So what are we missing? Why did the market just shrug this off?
Well, look, the market clearly decided to look right past that margin compression. I think they see it as temporary, winter seasonality, some weather issues. Instead, they're focused on the execution, the cash flow, and something we're going to get into called the emerald sky potential.
Okay, let's dig into that execution. This brings us to our first big theme, the mix shift magic. I'm looking at the data, and it says the number of homes they sold actually went down. How on earth do you grow revenue selling fewer homes?
It's a classic strategy, right? Price over volume. The total U.S. homes they sold actually dipped about 2.6%.
What?
Champion's average selling price, their ASP, it jumped.
Oh, what?
The average price for one of their homes is now $99,300. That's up almost 5% from last year.
So fewer units, but the units they're selling are more expensive. But wait, isn't this company's whole thing supposed to be affordability? How does raising prices fit into that?
That's the nuance. See, they aren't just jacking up prices on the same old product. They're shifting the mix of what they sell.
What does that mean?
They're pushing more multi-section homes. So think less single wide trailer and more. Like a ranch-style house that gets delivered to the site in 2 big pieces.
Okay, so bigger homes, more features. They look more like a traditional house.
Exactly. They're attracting a buyer who is priced out of a site-built home, but wants something more substantial than what they might picture when they hear manufactured home.
And these bigger homes obviously carry a higher price tag.
Higher price tag, yes. But here's the other part of the magic, and this is critical for their margins. They're selling more of them through their own stores.
The captive retail strategy. Okay, break that down. Why does that matter?
It's all about capturing the whole profit. If Champion builds a home and sells it to a third-party dealer, Champion makes the manufacturing profit and the dealer makes the retail profit.
Okay.
But if Champion sells that same home through one of their company-owned stores, they get both. They got the manufacturing margin and the retail margin.
So they're just cutting out
The middleman, exactly. They're vertically integrated. So they can sell a few less homes, but actually make more money on each sale. That's how you beat revenue when the industry is slowing.
That's smart. Okay, so that explains the revenue beat. But I think the real buzz, the thing that got the bulls really excited, was a specific new product they mentioned, the Emerald Sky.
This is a huge deal. Management made a point to highlight this. The Emerald Sky isn't just a new model, it's a statement of intent.
What are the specs?
It's a 1,600 square foot home, 3 bedrooms, 2 baths.
That's a normal starter home. I mean, that's a good-sized house. Hit me with the price tag.
The consumer retail price is around $185,000.
185. So let's sit with that for a second.
Mm.
The average new site-built home in America is hovering around what? $500,000?
$500,000, yeah. And that is the moat. That is the entire investment thesis in one number. They're attacking what they call the affordability funnel.
They're going after everyone who's just been completely priced out.
Which, let's be honest, is a massive part of the population right now. A young family, a retiree. You can't make the math work on a $500,000 house with mortgage rates at 6 or 7%. The payment is crushing.
No way. But 185,000?
Yeah.
That's doable. That changes the entire calculation, even with higher rates.
You are offering a full-size family home for less than half the price. That is a growth engine that is almost recession-proof. You aren't competing for the rich guy. You're catching everyone who's getting squeezed out of the middle class.
It's incredible. You literally cannot build a traditional stick-built house for that price in most of the country. I mean, the permits and the lumber alone would cost more than that.
You can't. The only way the math works is with factory efficiency. Building indoors, assembly line, bulk material purchasing. And this brings us to the next big tailwind, which is regulatory.
Right, because historically, the problem hasn't just been the price. It's been the zoning and the financing, the whole not in my backyard thing.
Exactly. But the tone on the call about Washington, D.C. was, well, it was very, very different. There's real bipartisan support for this now.
They mentioned a couple of bills, right?
Yeah, the Housing for the 21st Century Act and the Affordable Homes Act. But the holy grail, the thing they're really pushing for, is the ability to build these homes without a permanent steel chassis.
Okay, for those of us who aren't construction nerds, why is the chassis, that piece of steel underneath, such a big deal?
Because that steel frame with the axles is what legally defines it as a mobile home for a lot of lenders and zoning boards.
Ah.
And if it's a mobile home, you don't get a mortgage, you get what's called a chattel loan.
And chattel loans are terrible.
They are much higher interest rates, shorter terms. It's financed like a car or a boat. But if you can get rid of that chassis and put the home on a permanent foundation, it looks like a normal house, and crucially, it can be financed like a normal house.
So you get a 30-year fixed mortgage at a normal rate.
Precisely, which lowers the monthly payment even more. The CEO, Tim Larson, said he was just in Dallas with the HUD secretary's team touring their plans. The whole regulatory environment seems to be shifting from a headwind to a massive tailwind.
Wow, that's a game changer. It basically erases the line between a manufactured home and a site-built home for the consumer and the bank.
Exactly. And the market loves a regulatory catalyst. It can transform your addressable market overnight.
Okay, so we've got the product, we've got the politics. Now let's talk about the piggy bank, because this company is building a fortress of cash.
The balance sheet is a rock. They ended the quarter with nearly $660 million in cash. And get this, they generated $100 million in operating cash flow in just this one quarter.
That's a cash machine. And they've got more coming in, right? There was this deal with ECN Capital.
That's right. It's a bit of financial housekeeping, but they're exiting a stake they held in ECN Capital.
And what's the payout on that?
They're expecting a check for about 189 million Canadian dollars.
Okay, so let me get this straight. They have 660 million US in the bank. They've got another, 140 million US coming from Canada?
Yeah.
They are sitting on like $800 million in cash.
More. And that's on a mid-cap stock. It just gives them immense optionality. In a shaky economy, the market loves that kind of certainty. If things go bad, Champion doesn't go bust, they go shopping.
Or they buy themselves. They're already doing that, right?
They are. Bought back $50 million in stock this past quarter, and the board just re-upped the authorization to $150 million.
See, this is why the stock rallied.
Yeah.
When you have that much cash, you can support your own stock price. You are your own backstop.
It also gives the new CFO, Dave McKinstry, a ton of firepower. He just started in January. The market likes that he's an insider, but they love that he walks in the door with a huge war chest ready to deploy.
Speaking of the new CFO and looking ahead, let's talk about the guidance. Yeah. Because for a stock that ripped 11%, the outlook for next quarter wasn't exactly stellar.
No, it was cautious. Honestly, it was borderline sandbagging. They guided revenue to be up only low single digits. And they warned gross margins would tick down a bit more to between 25 and 26%.
So they're saying things are going to be a little tough.
Yes. They cited, winter weather, cautious consumers, the usual stuff. But there was one little detail in there that I think the smart money really latched onto.
What was that?
Management noted an inventory build at their own retail stores.
And usually inventory building up is a bad sign, right? It means you're not selling stuff.
Usually, yes. But the way they framed it was different. They called it readiness for the spring selling season. In other words, they aren't stuck with inventory. They're loading the cannon.
Ah, I see. So they're betting that when the snow melts, demand for that $185,000 house is going to just explode.
That's the read. You can't sell from an empty wagon. So they're taking a small margin hit now in Q4 by carrying that inventory so they can absolutely blow out the numbers in Q1 when the buyers show up.
That makes a lot of sense, actually. It's a strategic move.
And it explains the catch-up trade. Before this pop, SKY was actually down for the month, while the regular homebuilders ETF was up almost 8%. This earnings report was the market waking up and realizing factory built is taking share from site built.
Okay, we've covered a lot. The mix shift, the emerald sky, the chassis, the cash pile. I think it's time.
I think I know where you're going.
It's time for the segment. This is not financial advice.
Yeah.
I'm going to pitch you a trade. It might sound outrageous, but it's plausible. Ready?
I'm ready. Let's hear the pitch.
I call this one the double wide cash arbitrage.
Double wide cash arbitrage. Okay, you have my attention.
Yeah, here's the thesis. The market prices Champion Homes like it's a boring cyclical trailer company. But if you look at the balance sheet, it is a cash-rich fintech in disguise.
A fintech? That's a stretch. Go on.
Just follow the money. They've got almost $1 billion in liquidity between the cash on hand and the ECN check coming. On a company with, a $4 or $5 billion market cap, that means nearly 20% of the company's value is just cash.
It's a very high cash floor, yes. It provides a huge safety net.
So here's the trade. You go leveraged long. You buy out-of-the-money call options for the May expiration. Why May? Because that gets you past the next earnings report and right into the heart of spring.
You're playing for that spring selling season surprise.
Exactly. Management guided down. They sandbagged. They're loading up inventory. The real catalyst is this. When that ECN check clears and the spring sales numbers look great, the new CFO is going to look at that billion-dollar pile of cash, and he's going to have to do something with it.
You're predicting a major capital allocation event.
A huge one. I'm talking a massive tender offer for shares or a giant special dividend. So you get the pop from the earnings beat, plus the kicker of a massive cash return to shareholders.
That's a lot of potential upside. What's the hedge? What if the consumer really is dead and spring is a bust?
Easy. You hedge by shorting the luxury home builders that's selling million-dollar McMansions. If the economy really tanks, luxury is the first thing to go. People trade down into a Champion home. They don't trade up into a Toll Brothers.
So you're long affordability, short luxury. It's a bet on the affordability supercycle.
You got it. You catch the rotation. If the economy is good, Champion wins on volume. If the economy is bad, Champion wins because they are the only option left.
It's bold. It relies on the new CFO being aggressive right out of the gate. But I will say, the logic is sound. The cash provides a downside buffer that those luxury guys just don't have.
That's the double wide cash arbitrage. And of course, remember everyone, this is for entertainment purposes only. Please do your own homework.
Always. But that affordability moat thesis is very real. In a market where housing is the #1 pain point for consumers, the company that solves the pain point usually wins.
So to wrap it all up, Champion Homes delivered a beat, they shrugged off some margin pressure, and they proved that in this high-rate world, a $185,000 house might just be the hottest product in America.
The market voted with its wallet, and 11% pop says affordability is the winning play for 2026.
We'll be watching the tickers to see if that emerald sky turns into gold. Thanks for tuning in to Talk Tickers.
See you next time.